Hi, I'm Steve Dudash, IHT Wealth Management. Welcome to this week's Wealthcast. All right, I want to talk about the bank stress tests that came out this week. That was kind of the big story. Really maybe help break it down and make sure you guys understand what it really means to your situations. One bank got crushed. I mean, there's just no polite way of saying this. Deutsche Bank came out and just failed. Everyone knew they were going to fail. I doubt many of you guys have money either on the banking or investment side with Deutsche anyway, so it's probably not that big of a deal to you. Deutsche, they're not going to unwind their U.S. division anytime soon, maybe, but you know, they did poorly. And really, when we're talking about these stress tests, just so you understand, it's just basically the government putting some hypotheticals in place saying, if this took place, would your bank be able to survive? They don't want banks to fail like '08. And I'm not saying Deutsche is going to fail, but it just means if those scenarios were to happen, something dire like '08 were to happen again, what banks would be in a better position than others? And because Deutsche did so bad, it basically said you can't distribute any more of your money, you have to shore up your balance sheets, things along those lines. That was expected. Goldman and Morgan Stanley, though, which probably affects more the people watching these videos, passed, kind of, with little asterisks next to it, said you guys passed, but you can't increase distributions and you need to shore up your balance sheets. And I know some people say, well, it happened because they took all these one-times because of the tax code changes. The reality is all the banks did the same game in the first quarter, and those two banks happened to do it worse than others. Now what that really means to you guys is if you have money at Morgan or Goldman, realistically, they gotta increase their balance sheets. I mean, that's really what it boils down to here. So their savings rates, their bank rates aren't going to go up, as much as other institutions, and likely their fees and their costs of doing business with those institutions are probably going to increase a little bit, just to get them more in lines. Their bank accounts or their balance sheets more in lines with where the other institutions are at. Will that dramatically affect any of you guys? No, but it's something to keep in the back of your mind when you're looking at what you're paying to do business with them or what you're getting paid on your bank accounts or money market rates with them. They probably aren't going to be as competitive for the next year or so because they got to catch up. I mean, really, that's what it boils down to. That being said, this is not '08. This, generally speaking, is better than what it was a year ago, 3 years ago, 5 years ago. Regulatory costs and hurdles are probably going down in the U.S. I think we spiked a couple of years ago, and we're now on the other end of that spectrum. I talked about this a few weeks ago, maybe a few months ago now. We're still keeping an eye on that because if some of these institutions, and let's just say Morgan or Goldman, whatever, starts doing more aggressive trading or more aggressive leveraging, which is what happened in '08, in order to catch up to the other institutions, if they start doing that, we got to keep an eye on that because that is the number one risk that is out there with what's going on. If banks start playing silly games like they did in '05, '06, '07, '08, if we start seeing that again, that's where we got to be careful. But we're keeping an eye on that. So it's a quick version of what happened this week in the banking world. If you have any questions, call, email, text, Twitter at IHT Wealth anytime. Hope this helps. Have a nice weekend. Take care.